Welcome to the Deep Dive. Today, we're embarking on an exploration of a principle that is, well, deceptively simple, yet really profoundly powerful. It's how small, consistent steps, when you nurture them over time, can compound into genuinely massive wealth. We're calling this the snowball effect.
Yeah, it's a concept that truly underpins successful long-term investing. And at its very heart are the insights championed by two giants in the field, John C. Bogle.
The index fund pioneer.
Right. And Benjamin Graham, often called the father of value investing. What's particularly fascinating, I think, is how their distinct philosophies sort of converge on this exact same undeniable truth about building wealth.
So our mission for you today is to really extract the deepest, most actionable insights from their wisdom. We're primarily drawing from Bogle's Common Sense on Mutual Funds and Graham's, well, seminal works, The Intelligent Investor and Security Analysis. We're not just summarizing here. We want to peel back the layers to show you how their foundational ideas, when you apply them with consistency, with discipline, can genuinely create a financial snowball that grows relentlessly for you.
Exactly. We'll dive into the what and why behind this snowball principle. We'll connect the dots on how discipline, unwavering patience, and crucially, avoiding those common behavioral pitfalls.
Yeah.
How they're far more effective strategies than constantly chasing fleeting market trends or trying to predict the unpredictable.
Okay, let's unpack this core idea first then, compounding. John Bogle famously called compound interest a miracle. Now, for many investors, maybe even seasoned ones, that term might feel a bit abstract. What does Bogle truly mean by calling it a miracle, especially for someone just starting out?
Well, if we connect this to the bigger picture, Bogle's miracle isn't about some, secret formula. It's really about the exponential power of time. He emphasized, and I'm quoting here, "Give yourself all the time you can. Begin to invest in your 20s, even if it's only a small amount, and never stop."
Wow.
Yeah, and this isn't just a suggestion, it's a profound mathematical truth. Imagine two people both investing just $200 a month.
Oh.
So one starts at age 25, the other waits until 35. Now, assuming a pretty modest 7% annual return, by age 65, the person who started at 25, they'd have accumulated over $550,000.
Just from $200 a month?
Right. But the one who waited just 10 years, they'd only have around $250,000. That's more than double the wealth just by giving your money an extra decade to compound, even with the exact same monthly contribution.
That really drives it home.
The miracle is that your money starts working harder for you, earning returns on its own returns. It snowballs.
That example really clarifies the miracle part, so it's less about huge lump sums initially and much more about consistent long-term effort. But you mentioned market cycles, and Bogle's book talks about the long spring and summer of bull markets, but also the inevitable fall and winter. For someone trying to stay consistent, what does that imply about sticking with it, especially when the market feels like it's, in a deep freeze?
That raises an absolutely critical point about investor psychology, Bogle's seasons analogy. It reminds us that cold, dark winters will give way to bright, bountiful springs. The implication here is that market downturns aren't just normal, they're predictable parts of the cycle.
Right, they happen.
They happen. The key, he stressed, is managing your emotions. Impulse is your enemy. Eliminate emotion from your investment program. This means that during those winters, when every instinct might scream sell, or during summers when the urge to chase hot stocks is strong, you just have to resist.
Easier said than done sometimes, I think.
Oh, absolutely. But this consistent, unemotional, almost robotic approach allows compounding to keep working its magic over the decades, regardless of that short-term volatility. It's about understanding the market recovers. And those who stay invested benefit from that inevitable recovery, often buying lower without even consciously trying.
That makes perfect sense. It's about riding out the waves. Okay, now, here's where it gets really interesting, I think. And it's a point both Bogle and Graham make passionately, often with surprising vigor, the impact of investment costs, often underestimated.
Oh, definitely.
Bogle states, cost matters. Small differences in compound interest lead to increasing and finally staggering differences in capital accumulation. How staggering are we actually talking when we dig into the numbers?
The numbers are truly compelling. Maybe even shocking for some people. Let's take that same $10,000 initial investment, okay, but over 50 years this time.
50 years, right?
A low-cost program, like a broad index fund with an expense ratio of, say, 0.2% per year. That could yield an annualized return of about 8.6%, allowing that initial 10 grand to grow to an incredible $1,080,000.
Oh, okay.
Now, Compare that to a high-cost, actively managed fund, maybe with an average expense ratio of 2.2%. That seemingly small 2 percentage point difference. It means your money only yields 7.3% annually, resulting in a terminal value of $578,000.
Wait, so that's nearly half,
Yep.
just from a 2% difference in fees.
You've earned nearly double the wealth simply by choosing the lower-cost option. This isn't theory. It's just the cold, hard math of compounding costs working against you.
That's not just astonishing, it's kind of infuriating when you think about that loss potential. And it's not just those explicit fees, right? The sources mention hidden costs. What are those exactly? How do they quietly eat away at returns?
Yeah, you've hit on a crucial point. Bogle really hammered home the concept of fiscal drag. When we talk about actively managed funds, beyond their stated expense ratios, they often incur significant portfolio turnover.
Meaning they trade a lot.
Exactly. Constantly buying and selling stocks, often averaging around 80% of their portfolio annually. This trading generates hidden transaction costs, brokerage commissions, bid-ask spreads, which can easily add another 0.5 to 1.0 percentage points, or even more to the total cost.
On top of the expense ratio.
On top of it. So add that to an average expense ratio of, say, 1.5%, and the aggregate fiscal drag can easily exceed 3% per year. The source gives a stark example. An index fund started August 2, 1982, with $10,000 invested, would be worth $153,100 by December 2008.
Okay.
But an average actively managed fund, with all those costs factored in, only worth $113,700.
That's a huge difference again.
It is. This is the tyranny of compounding at play, a term Bogle actually coined. Just like positive returns compound, so do these negative drags. These seemingly small costs drastically reduce your terminal wealth over time. They effectively consume almost 1/3 of a hypothetical 10% annual return.
A third.
And there's more. High turnover also creates capital gains taxes for investors, often year after year, even if they don't sell their shares in the fund. This erodes returns further. Index funds, because they trade so little, are inherently much more tax efficient. That's another layer to their better performance after taxes.
The tyranny of compounding. Wow, that's such a powerful phrase. It really captures how these small leaks sink the ship over time. So it sounds like avoiding high costs is absolutely critical for letting compounding work for you. But the sources also warn against another, maybe more seductive pitfall, the allure of short-term speculation. Graham talks about the market not as a rational calculator, but as a pendulum. Can you elaborate on that analogy? What's it warning us against?
Graham's market pendulum is, I think, one of his most vital insights. He wrote, and I find this so profound, the market is a pendulum that forever swings between unsustainable optimism, which makes stocks too expensive, and unjustified pessimism, which makes stocks too cheap.
So, emotional extremes.
Exactly. The intelligent investor, he argued, is a realist, someone who doesn't get swept up in these emotional swings. You essentially sell to optimists and buy from pessimists. It emphasizes deep emotional discipline over trying to forecast those swings, which Graham just dismissed as a fool's errand.
A fool's errand, yeah.
The pendulum swinging means the market price right now isn't necessarily the true value. It's often just reflecting collective greed or fear. Trying to time those swings perfectly, buy at the absolute bottom, sell at the absolute top, it's virtually impossible. And usually it results in investors doing the exact opposite of what they should be doing, buying high, selling low.
That makes so much sense, resisting the herd mentality. And Bogle, looking at actual mutual fund investor behavior, he noted they continued their consistently counterproductive investment patterns with rapid turnover of holdings. It seems even the pros, the fund managers you'd expect to be more rational, fell into this trap of chasing short-term gains, didn't they?
Oh, absolutely they did. And the numbers Bogle cites are, well, pretty astonishing. From the 1940s to the mid-60s, typical equity fund turnover was around 17% annually. That implies they held stocks for roughly 12.5 years on average.
Okay, a long-term view.
Right. But by 1997, it had skyrocketed to 85%, meaning stocks were being held on average for only slightly longer than 1 year.
Wow, huge shift.
Massive shift. It reflects this relentless pursuit of unrealistic performance through costly short-term strategies. Strategies that, as Bogle saw it, just distract them from one of the most important secrets of investment success: simplicity.
Simplicity.
Both Graham and Bogle were adamant. Don't buy a stock just because it's gone up recently, and don't sell just because it's gone down. They specifically warned against using complex mathematical models to try and predict the future or what they called forecasting the stock market for profit. The market's short-term moves are just too random, too driven by emotion to be reliably predicted.
Okay, so if complex short-term strategies and speculation are out, what's the genuinely simple, proven path? The one that lets the financial snowball actually grow. Bogle is, of course, famously known for index funds. How did that idea even come about, and why is it seen as such a simple yet powerful solution?
Well, Bogle's creation of the first index mutual fund back in 1975, it was initially mocked, actually, called Bogle's Folly.
Really, Bogle's folly.
Yeah. It was a revolutionary act of simplicity at the time. His core argument was just elegantly logical. Yeah. If the aggregate market is simply the sum total of all investors, then trying to beat that market, especially after costs, has to be a losing proposition for most people, right? It's simple math.
The average can't beat the average.
Exactly. So why not just own the entire market? His fund didn't require fancy investment management beyond simply owning all the stocks in a broad index like the S&P 500. This meant ultra-low costs and minimal turnover, minimal taxes. And you had figures like the legendary Peter Lynch saying most investors would be better off in an index fund. Or John Fossil, who clearly stated people ought to recognize that the average fund can never outperform the market in total.
The results speak for themselves, then.
They really do. Statistically, the index fund typically captured about 99% of the annual market return. Meanwhile, the average diversified, actively managed equity fund, bogged down by costs and turnover, captured only about 87%. It's a powerful illustration of how less really is more in investing.
And Graham's perspective on broad diversification, rather than trying to pick individual winners, that aligns perfectly with this simple, broad market approach, doesn't it?
Okay.
He often emphasized safety for the intelligent investor.
Absolutely. Well, Graham certainly taught deep intrinsic value analysis for, let's say, sophisticated or enterprising investors. He strongly advocated broad diversification for the typical, what he called the defensive investor.
The everyday person.
Right. He writes that for the vast majority, not diversifying is foolish, since it is so difficult to select a limited number of stocks that will include most winners and exclude most losers. His logic is just compelling. As you own more stocks, the damage any single loser can cause will decline, and the odds of owning all the big winners will rise.
Spreading the risk.
Spreading the risk and capturing the winners. He ultimately concluded, and this connects directly back to Bogle, that the ideal choice for most investors is a total stock market index fund, a low-cost way to hold every stock worth owning. This directly bridges his value principles, focus on protecting capital, avoid big mistakes with Bogle's indexing strategy. It reinforces that simple, low-cost path to capturing market returns.
So for Graham, buying the market meant you were always buying companies at sort of a fair value on average and avoiding that huge risk of picking the wrong individual stocks.
Precisely. It removes the need for prediction and minimizes the chance of catastrophic error.
What an incredible deep dive today. It feels like we've really unpacked the profound yet ultimately simple wisdom of Bogle and Graham. It truly seems to boil down to this consistent, disciplined action, letting time and compounding do the heavy lifting, and fiercely guarding against those twin enemies, high costs and emotional short-term speculation. It's really about patience, isn't it, above all else?
It really is. Yeah. And it's a powerful reminder that, the secret of investing is finally that there is no secret. It's not about finding some hidden gem or predicting the future.
Yeah.
It's about understanding a stock as owning part of a real business.
Right.
Recognizing the market's inherent irrationality sometimes and consistently focusing on protecting your capital and thinking about intrinsic value rather than chasing fleeting predictions or overly complex models.
The snowball effect. It isn't magic in the, mystical sense, but when you actually witness the power of compounding over decades, it certainly feels a bit like magic.
Yeah, it does. And what truly stands out here, I think, is that by embracing these simple principles, you aren't just accumulating wealth, you're actually cultivating a mindset of patience, rationality, long-term thinking. And that can serve you far beyond just your financial portfolio. You're becoming an intelligent investor in life too, perhaps.
That's a great way to put it. So maybe consider this. If the tyranny of compounding can quietly work against you, silently consuming your potential wealth through costs, just imagine the profound freedom and wealth it can deliver when you consciously harness its full power for you. Through consistency and simplicity, what small, consistent investment, what disciplined choice will you make today to truly get your own financial snowball rolling?